Everybody. Hopefully everyone can hear me. I think it's 10 o'clock on the dot, and in the interest of time, want to get started with the session. I think Helen's doing the introduction of the other session, so I don't think I get a formal introduction, but so I'll introduce myself. I'm John Krasansky. For those of you that don't know me, I am a principal in our accounting and assurance group, as well as our nonprofit advisors group. I'm going to try to share my screen here, hopefully successfully. Okay, looks like that worked. Just if anybody has trouble hearing me, please, put it in the chat, let me know. But otherwise, we'll get started here. I'm lucky enough, I guess, to do the financial reporting and accounting update. This is the pandemic edition. It's not as exciting as, say, fraud, although there is overlap there as we talk about internal controls and single audit considerations. But it is a necessary evil to keep up with the standards, the accounting standards, both from an accounting standpoint, as well as, from an auditing standpoint and an external reporting standpoint. If I can get this to advance, oops, a quick finger there. Again, you can see me on the screen, but here's another picture with my email address. If you put questions in the chat and we don't get a chance to get to them, being only a 50-minute session, please reach out to me via email. I will do my best to get back to you either today or tomorrow, to respond to any questions that you might have, on my session or any other accounting related items that are related. So just to go through what we're going to touch on today, I'm going to start the session going through all the pertinent accounting standard updates. I say pertinent because oftentimes, a standard will come out and it doesn't apply to a nonprofit, or it applies, but only to a select group of nonprofits. So maybe not anybody in this group. We'll touch, I have listed out all the accounting standards that have come out, but we're only going to touch on certain ones that actually will have an impact on the nonprofits. And so we'll go through all the ones that came out in 2020 and the ones that have come out in 2021 to date. And then I'll go through a couple other select ASU's accounting standard updates, because oftentimes an accounting standard will come out and it'll take 3, 4, 5 years before you actually implement it. So there are still some trailing ones that are out there that came out prior to 2020, and just really want to give you a reminder that those are still kicking around out there, and to keep them on your radar. And then we'll conclude by going through, a little bit with the pandemic. I know everyone's kind of tired of that a little bit. We all have a little bit of fatigue related to that, but just going through the impact on nonprofits, and then accounting considerations for a lot of the stimulus monies, and then also single audit considerations. And to the extent there's time, we'll touch on the impact of these items with debt covenants as well as going concern. So with that, we're going to get into the accounting standard updates that came out in 2020. The one thing I want to point out with accounting standard updates is that, we went through a number of years where there were a lot of updates that came out. We kind of looked at it and said, boy, we're really getting into this overload here with all these standards, and we're really getting a lot of fatigue with having to implement them. From the nonprofit standpoint, you've realistically dealt with the changes in the nonprofit standards where your financial statements changed a little bit, and how you showed restricted versus unrestricted or net assets without restrictions. We had to implement a new cash flow standard where we started to lump in all the restricted monies with cash in the cash flow, whereas before, that was separate, and any movements on the ins and outs of your operating account and these restricted accounts would be shown in investing activities. That kind of went away. So there's been a number of things, and also a contribution standard that was implemented last year for most, kind of looking at how you record contributions and the restrictions of such, and when you recognize in revenue. And so all these things have come about recently. And what ended up happening was, because of COVID and because of the pandemic, we've seen a slowdown in accounting standard updates. And in fact, there's only been 6 so far in 2021 that have come out. And in 2020, there was only 11 that were issued, which really, that's the lowest since 2012. And so for a number of years, we had a lot of standards, and a lot of them impact your organizations. But now we've seen a slowdown, and even some of the ones that have come out now either are deferring standards that have yet to be implemented, or they're in response to the pandemic in some related way, or they're clarifying an old standard. So they're really, that being said, there's really not a whole lot of new earth-shattering ones, but there are still some accounting standards that we should touch on with that. And the one thing I also want to point out is, as we talk about an accounting standard update, you always have to think about, is it material to my organization? Because if it's not material, you may not necessarily have to address it other than taking the time to assess whether it would be material or not. So certain things we talk about, you may say, boy, we have that, but it's really not a big part of our organization. It really doesn't matter. It's probably not worth taking the time to do that. So you'll just, kind of want to assess that and potentially move on, so you could spend your time focusing on other items that really impact your organization more so than an immaterial accounting standard update. So just jumping into these accounting standards now, update 2020-01, investments in equity securities. This actually isn't in effect until December 31st, 2022, or fiscal year June 30th, 2023. And what this relates to is, if you, in your investments, in your endowments, in your foundation, whatever the case may be, if you for some reason are investing in securities that don't have a readily determinable fair value, meaning they're not actively traded, it's hard to really understand what they should be worth. This gives you a measurement alternative to recognize those at cost, minus any impairment that you're aware of, and any other observable price changes. So this would be if you, for whatever reason, are investing in, say, like private company stock, which can happen, but it's not very common. Then this standard would apply to you, and it allows you to not have to try to figure out what the fair value is, and really just record it at cost, plus or minus any changes that you know about, whether there's impairments or others. So for example, you invested in this company and you know it's going out of business. Obviously that would be an observable change, and you would then have to react to that. But other than that, it really probably doesn't impact many in this breakout session. And then update 2020-02, that is really an SEC update. So this is a public company update related to the credit losses standard, as well as leases. We'll talk about leases on an upcoming slide, but credit losses, I didn't really touch on too much in here. That's also an older accounting standard update that came out a couple of years ago. And originally when that came out, the thought was it really was only going to impact banks and other financial institutions. But when you really dug into it, you found out that it really will impact every organization in the form of how they assess accounts receivable and collection of such, and any bad debts or allowance for doubtful accounts that should be recorded. And it's going to impact how you assess whether you are going to have bad debts or what the reserve should be, as well as additional disclosures relative to that assessment. So in future years, as we're doing updates, we'll touch on that in more detail, but that's also kicking around out there. But this particular update was is for SEC clients, so it doesn't impact anybody in this breakout session. And then 2020-03, you'll see this throughout, where there's codification improvements. Once the FASB went to the accounting codification, what they've done is, that was really to clarify standards and try to group them together in similar areas, so it's easier to research topics. And over time, they find ways that they feel the codification should be improved. So it's just kind of tweaking clarities, and it's the clarity of it, and it's an ongoing project of the FASB. So oftentimes you'll see these codification improvements, but they really don't mean anything. They don't really change anything. It's just trying to make it easier for you to find what you're looking for should you need to research something in that area. And then update 2020-04 relates to reference rate reform, and this has to do with the transition from LIBOR to the alternative reference rates that are out there. So a lot of you may have bank debt that your interest rate is based on LIBOR plus some factor. And the global markets are moving away from LIBOR. It's set to expire now in June of 2023. They've actually pushed that out a little bit based on the pandemic. But the issue is that if you have an existing loan and your interest rate is LIBOR plus some factor, then your financial institution is going to need to transition you from this LIBOR rate to some other rate that's out there. Okay. Now, a popular one that we're hearing about that's being done right now is the short-term bank yield. It's Bloomberg short-term bank yield. But what we're also hearing is that banks and financial institutions are hesitant to transfer these existing contracts to anything other than LIBOR right now. So we're not really seeing it yet. Some new contracts and new debt might be having a different rate than LIBOR, just because we know it will expire during that time frame, but we're just not seeing that transition from existing documents and existing debt to a different rate. Once you go through that, should you go through that, then this standard would come in handy as far as how do we account for it, this change in the interest rate. And there's even an update in 2021 in the form of ASU 2021-01 relative to that. But right now, it's not really impacting much because a lot of the banks haven't made that move yet to change away from the LIBOR. And then update 2020-05, this one was a very timely update, and it helped a lot of organizations. And this came out in June of 2020. So, just a couple of months after, we really learned about COVID and you had the shutdown and whatnot. And what this did was it deferred the effective date of the Revrex standard and leases additional years. So what happened with the Revrex standard was initially it was supposed to be implemented for, nonprofits that didn't have publicly traded bonds. You were supposed to implement it 12/31/19. And so your audits were being done there in the spring of 2020. And maybe you were going through that implementation process. Maybe you were behind because of the pandemic or what have you. So when this standard came out in June, it provided relief to those organizations that hadn't issued their financial statements yet, and allowed them to defer implementing revenue recognition until December 31st, 2021. So that a lot of times, though, what happened was if you were an organization where your audit typically got done in April or May, or maybe it was close to done but wasn't issued yet, you'd already gone down that path. You already had all the new disclosures. You already assessed how revenue recognition would affect you. So a lot of organizations weren't able to take advantage of that at that time, but some were, because some nonprofits don't really get their audits done or wrap up their financials until the summertime, and so that was a big benefit for them. And then leases, that got pushed out even further to be effective December 31st, 2022. However, we'll talk in a little bit that there's even talk now that could get pushed out even further. At least there's a request for that, which we'll touch on a later slide. Update 2020-06 is a for-profit accounting standard, so I'm not going to dig into that one. But 2020-07, that is actually specific for nonprofits. It's part of the codification topic 958, which is specific to nonprofits. And it talks about presentation and disclosure of contributed non-financial assets. Okay, and it's effective for annual periods beginning after June 15th, 2021. So that's calendar year 2022 year ends, or June 30th, 2023. And retrospective application is required. So if you have comparative statements, you'll need to show it in both periods. And what this is doing is it's increasing the transparency of when an organization gets something donated to them that isn't like a contribution or a grant. It's not money. It's not readily defined as to what the value is of it. Okay. And what it's going to do is it's going to say that depending on the nature of what's being donated to you, you may have to break it out on separate financial statement line items. And there's certainly going to be more disclosures about how you value this item and how you use this item. Okay. So just some examples would be, maybe you're getting computers donated to you, furniture, whatever the case may be. Perhaps it's expert advice, legal advice, business advice being donated to you. Or maybe it's something in the form of space, office space for a meeting, mail services, whatever the case may be. These are all different items that you would have to potentially break out separately, both in dollar amount as well as in your disclosures. And again, what I think of in this is materiality. Will it be material to really break it out amongst all those sections or different types? It might be, but it's something that's out there, and it is something that's going to impact most, if not all, nonprofits in some way, shape, or form, at least in the fact that you'll have to assess whether it's going to be material to your organization or not. But that's still, a year or two down the road. And then moving through the rest of these 2020-08 updates, again, 2020-08 is really just an improvement to the codification. It gets into a little bit more detail on subsequent measurements of debt, if it's callable, if you have callable debt, how to measure that. So that's part of that standard there. 2020-09 is a public company update, so we'll pass on that. 2020-10 is more improvements to the codification. Again, just further clarification. And really, the 2020-10, it's more focused on financial statement disclosures. And it really is just trying to clarify what's in the codification relative to disclosures to make it less likely that a financial statement preparer will miss a disclosure that's required. So that's all they're really doing there. And then 2020-11 is specific to the insurance industry. So, that will pass on that. So those were all the 11 accounting standard updates that were issued in 2020. We get into 2021 where there's only 6 that have been issued. And the first one is just a scope modification on the reference rate reform we already spoke of, and that's the shift out of LIBOR. So that's just an update there. Again, we're not really seeing that in our client base just yet. And 2021-02 relates specifically to franchisors, so we're not going to talk about that in this session. But 2021-03 we will. This was actually a really big one for all organizations, including nonprofits. And this came out as you're in the midst of your December 31st, 2020 audits, right? And it's the first audit period for those that didn't have a 6/30/20, there weren't a 6/30 year end, where you're really dealing with COVID and the related impact of COVID, okay? And typically when you have goodwill on the books, what you would need to do is, if there was a potential impairment of this goodwill, you would have to make that assessment and adjustment at the time of impairment. So what that means, if you're a calendar year end and something happened to your business in June where all of a sudden that goodwill wasn't supportable, the value of it wasn't supportable anymore by your business, you ultimately would need to make this goodwill impairment write-down adjustment in June when it occurs, regardless of your year end, okay? What this accounting alternative offered was that you didn't have to make that assessment anymore throughout the year. You could make that assessment at the end of your reporting period. And that was critical in 2020, because a lot of businesses that experienced interruptions, shutdowns, whatever the case may be in March, really, when you looked at it in the summer, you say, boy, we're really struggling now. We're going to have to write down this goodwill or write it off. However, as the summer went on, things opened back up, people were doing more, businesses started to rebound. Then it was a different ballgame by the end of the year, potentially, as to how you maybe felt about that goodwill. So this really afforded the opportunity for a lot of companies and organizations to not have to write down goodwill in 2020 because of the pandemic. Not saying it didn't happen, but it definitely made it a lot easier when you were assessing it to really look at, all right, how did our fourth quarter look? What's our outlook here in the first quarter of 2021? Does our goodwill value make sense? So it was a very critical update that came out early in 2021 that allowed goodwill balances to, for the most part, stay the same, assuming your business had rebounded. And then update 2021-04, that's the earnings per share. That's a for-profit standard, so we're not going to touch on that. And then update 2021-05 on leases. This has to do with lessors, and if you have variable lease payments in the lease, this theoretically could impact nonprofits, but I highly doubt that it's in any of our nonprofits or anyone in the room where you would be experiencing this as a lessor. So I'm not going to touch on that, just in the interest of time. And then 2021-06, which is the last accounting standard update that came out in 2021 so far, is an SEC update, so public company, and we're not going to touch on that. Just another accounting issue that has come up recently has to do with how organizations account for vaccines. So this isn't an accounting standard update that's out there. However, this is on the AICPA's radar, and they're going through and putting together a technical question and answer document to kind of go through that topic. And really, it's probably more prevalent if you're like a healthcare nonprofit and you're provided a lot of vaccines, whether it's for your employees, whether it's for your residents, or whatever the case may be. And how do you account for all that? And since there's such disparity in practice as to how that's done, there's two really potential options is, should it be accounted for as an in-kind donation, or should it be considered more of an agency transaction where you would record it more nets versus the in-kind donation, you would recognize it then as revenue. So, I guess stay tuned on that one, because there is a lot of disparity there until that technical question and answer document comes out to really guide you on that. Again, you have to get into materiality. What's the value of the vaccines? Are you a $20 million organization where this is probably immaterial? Those are the types of things you'll want to consider as, if you're in that situation where you're dealing with vaccines. And we're going to close the loop on the accounting standard updates by going through these other accounting standard update reminders. Again, for revenue recognition, for those that had not implemented it or taken advantage of 2020-05 last year, you'd be required to adopt it then December 31st, 2020. So most of those year-end audits should be done by now. And so that would have happened. Or if you're a fiscal year June 30th year-end, your June 30th, 2021 audits going on now would be the time that you would have to ultimately implement that. And in our client base, haven't already gone through the contribution standards and any changes relative to that last year. There isn't a whole lot of change with the revenue recognition from an accounting standpoint that we've seen. It's really just more on the disclosures. So whereas in the past, your revenue recognition footnote may have been a half a page, it might be a page and a half now, depending on how many programs you have and how many revenue streams you have to really detail out in your financial statements. Getting a little bit of sunshine here in my office, so I apologize for that. Then lastly, or not lastly, but I want to touch on the leases that we had talked about. So the lease accounting standard, which came out in 2016, that is still for nonprofits, still hasn't been, still hasn't been implemented, other than those that maybe had the publicly traded bonds. And a lot of organizations they're not struggling with it, but it is a lot of work. It's a lot of work to have to go through and see how many leases do we have, how many material leases do we have. And just as a refresher, this is where no matter if your lease is capital or operating, you would have to capitalize a right to use asset on your books and then have an offsetting liability for it, and then amortize the right of use asset throughout the term of it, and then reduce the liability as you make the payments. And from that perspective, there's a lot of operating leases that aren't on the books. A real easy, quick and dirty back of the napkin calculation would be if you go to your footnote disclosures, because we're required to disclose future obligations for operating leases. You might see sometimes in those footnotes, $5 million in future obligations or $6 million. So a back of the napkin analysis could lead you to believe you may have to pick up a $5 million asset on your books and a $5 million liability on your books to implement this new standard. So right now it's set to be implemented by December 31st, 2022 or June 30th, 2023. The challenge there is, if you think about it, December 31st, 2022 is next year. If when you implement the standard, you're actually going to have to implement it effective 1/1 of 22, January 1st of 22, to get that asset and liability on your books at the beginning of the year, so it's there for the whole period. Well, January 1st, 2022 is right around the corner. That's only 3 months away. So it's coming fast and furious. The good news is it's for annual periods. The effective date is for annual periods, 12/31/22. But if you have interim periods, meaning maybe you have quarterly reporting with banks or whatever the case may be, for interim periods, it's also not effective till 12/31/22 and thereafter. So in theory, if you produce first quarter 2022 statements, say for an external reporting requirement for whatever the reason, you would not have to have the lease standard implemented on that first quarter 2022, but you would have to have it implemented by the end of the year on the 12/31/22. So that's where that is now. Now, except for yesterday, there was a FASB board meeting, and one of the requests was that this standard be considered to be deferred an additional 2 years it says for private companies. Now, I assume private companies would be nonprofits. Sometimes they ultimately clarify when they do make those kind of changes. And I think from that perspective, we should just stay tuned, because now that's something that's been brought up. I assume if that does happen, we'd have clarity here, hopefully within the next quarter, whether that would be deferred again another 2 years. But that is something that came up yesterday in a FASB meeting. And so we'll see what happens with that. And the last accounting standard I'm going to touch on is just a reminder on the contributions made portion of update 2018-08. Obviously, this came out in 2018, and this is for if you're a resource provider and you're making contributions, then this standard would be in effect. And it's really no different than the contributions received, which was implemented last year on nonprofits. And we know that there was some impact there, but I don't really feel that most, if many in the room, really fall into where you're a resource provider making contributions. And so this probably doesn't impact that many, but I did want to point out that, it is effective here, 12/31/20, or was effective and will be 6/30/21 for those fiscal year providers. So now as we transition to some other topics here, I do want to give out my first word. My first word is drink, D-R-I-N-K, drink. And there's a theme to my words that I'm giving out, which we'll touch on later. So drink is my first word. Now everybody's favorite topic. So the COVID-19 pandemic. This, the pandemic, it gave us a chance to use words in ways we never used them before, and phrases. We'd always heard of, isolation and quarantine, but we never thought we'd hear it in relation to things that we were doing or needed to do, right? Or the phrase "wine with the wine." I never had thought about that before, but that was a popular thing that came about when DeWine was doing his daily 2 p.m. press conferences and everyone was working from home. So those were some interesting times and interesting changes. And, though we're not out of the woods on the pandemic, at least, we're back open and trying to operate as normally as possible throughout. But it doesn't mean there's not a lasting impact here. It doesn't mean there wasn't an impact in 2020 and a lasting impact here through 2021. I've pulled up a couple of surveys. One's from this BrightBridge that actually helps startup nonprofits get going and grow, as they're in their development stage. And so they had a survey in 2020. And I say 2020 because a lot of the 2021 surveys, have been done throughout the spring and summer, but a lot of the results aren't released yet. Those will come out probably more in, say, October, November. But as of now, a lot of the surveys that are out there still relate to 2020, but they're still relevant as to what nonprofits are experiencing. And so BrightBridge, in their survey, they found the 4 main challenges that nonprofits were facing. And these really shouldn't be a surprise to anyone, right? It would be compliance with various programs. If you have grants, trying to comply with them when you have shutdowns, you're in a remote or a hybrid environment, and trying to manage through that. Staffing, that obviously was an issue for everyone, both from a retention and do we need to lay people off to make it work, right? And then financial health, as there were shutdowns, you're not seeing the revenue stream maybe you once had. So what does that mean for our long-term financial viability? And then fundraising was a big one because, are your donors as willing to donate if they're struggling financially because of the pandemic, right? Or we're not able to have our normal fundraiser where we generally bring in X dollars. We tried to do it remotely, but it wasn't as successful. We're not having the opportunity to bring everyone together, have the silent auction or the paddle raise or whatever the case may be to generate additional funding. And so that was obviously a big challenge, and that was evident too in the survey results that came out. And also, no surprise here that 79% of the nonprofits had revenue decreases, and 38% of them had revenue reductions greater than 50%. Only 25% actually felt they had enough cash flow to cover their expenses and their spending, and 60% of them had to implement furloughs just to survive the pandemic. Okay, so again, no real surprises in those results. And then the other survey I looked at is from a cloud-based Sage, who's a cloud-based system that's out there. So they have more of like an IT spin on this. So these results came out in February of 2021, but obviously the survey was later in 2020. And so, a lot of nonprofits in this survey, they indicated they had program disruptions and issues with shifting, half their staff to being remote, right? And then, but the big thing that came out of this was, and I think everyone experienced it, was that, everyone felt that our technology, even though the technology was already out there, we were kind of forced into utilizing it at its highest and best use to make this work so that we can continue our programs. We can continue having people work even if they're not on site. I know there's challenges with that Mike and Tony talked about in their session, relative to how do you control that and make sure there's not fraud occurring and all that. But it was a necessary evil, and it was something that really kind of expedited, how we look at technology and how we use technology that theoretically had been out there even before the pandemic, but it's certainly improving every day as well, right? And then the last bullet point on here I wanted to touch on was that 70% of the survey respondents, they said that their social media strategy changed due to the pandemic. So you may have seen that yourself with how you market to potential donors, right? Or even maybe how your HR function is working, and are you utilizing technology more to identify candidates than before? So a lot of things had to change pretty quickly. We had to pivot, as Tony had said earlier. And every time I hear the word pivot, I think of that Friends episode with Ross when, the guys are helping him move that couch up the stairs and they have to keep turning and everything. And he keeps yelling pivot. So every time I hear that, that's what I think of. But so again, no surprises here, but it's all things that just as a reminder of some of the good, that came out of, having to flip to remote or having a hybrid work environment now and how we utilize technology. So as everyone is aware, there was a lot of different stimulus monies that came out that were available out there, a lot of relief. And all the relief was really focused on two things, right? It was focused on trying to help maintain a revenue stream, okay, to support then being able to retain your employees during this time. So, you had the Paycheck Protection Program out there that was available. So that was going to be monies to help keep your employees on staff and paid during this time. You have these relief funds that came out there from a healthcare perspective, provider relief funds, and then the coronavirus relief funds as well. And those are based trying to cover, lost revenues and other COVID-related expenses. And then you had other things in the form of the economic injury disaster loans, the ability to defer the employer portion of Social Security taxes, accelerated and advanced payments for Medicare and workers' compensation refunds. These were all ways to keep money in the business or in the organization, or to have an influx of money into the organization to help weather this, hopefully short-term storm. And then now it's been talked about more, although it's always kind of been there, is the employee retention credit. And again, that's a credit that's available out there to help, offset and be able to keep your employees retained and on your payroll. So the one thing I do want to point out, though, on the workers' compensation refunds, and if a nonprofit is self-insured for that, though, you wouldn't have seen those refunds because those came from the Ohio Bureau of Workers' Comp. But some are not. Every nonprofit is self-insured, so there were certain nonprofits that were able to benefit from that. And one of the things I have in the slide deck is a lot of general footnotes, just examples that are out there for the various, for the pandemic itself and the various funding that's out there. I'm not going to really go through them in detail, but I did want to go through some of the accounting aspects of certain of these funds, stimulus monies and loans that came through. But again, these are more just for you to have. If we're your auditors, then a lot of these have already probably been put into your financial statements or will be, but these are just some examples that are out there. But just touching on some of the accounting for some of the stimulus money, everyone was familiar with the PPP and really in the nonprofit sense, even though there were 4 options of how you could account for it, the 2 that were the most popular were the debt model or the government grant model under 958. And talking about the debt model that's under ASC 470, this was the basic way to do it, the easiest way to do it, where you would recognize it as a loan or as a forgivable loan. And once that forgiveness is approved, you would record a gain on extinguishment. Okay. And that was the easiest way to do it because you were never assessing forgiveness. You never had a guess or say, well, these are the 10 reasons why we know it's going to be forgiven and we want to recognize it in revenue. It's just park it in as a liability. And once it's forgiven, we'll recognize it through the statement of activities. If you accounted for it under this way, theoretically, you're supposed to accrue 1% interest on it because there is the 1% interest factor that ultimately gets forgiven with the debt at that point in time. And that was really there in case 100% of it wasn't forgiven, there would be an interest component due back. But for the most part, we didn't see organizations really accrue that interest just because it wasn't that material and ultimately would be forgiven anyway. And then the other way to record it which gave you an opportunity to kind of accelerate recognizing it as revenue, was under 958, okay? And what you would do there is once you got the PPP money, you would record it as a refundable advance liability, okay? And once you had reasonable assurance, meaning it was probable that the loan would be forgiven, then you could record it to other income because the conditions have been met. There's no more barriers in there based on your assessments. You have reasonable assurance it's going to be forgiven. So that allowed organizations then to kind of accelerate recognizing that in revenue, which I actually always kind of like that option because in my mind, all the related expenses really ran through your statement of activities in 2020 in the form of the payroll. So why shouldn't you be able to show the revenue to offset that? If you didn't do that, in essence, to me, you were creating an artificial deficit in 2020, and then you have an artificial gain in 2021 because those expenses were no longer there in your statement of activities. But I also understood just showing it as debt because that's obviously the easiest thing to do. In any event, regardless of whether you recognized it as a note payable or an advance liability, you would not include it in your liquidity footnote, okay? It wasn't something that was included in the liquidity footnote calculation. So just wanted to point that out. And then we have sample disclosures in here, relative to the PPP, which again, I'm not going to go through those in detail. And then there was an additional disclosure because any PPP loan in excess of $2 million was subject to additional scrutiny by the SBA. And, initially they came out and said, well, we're going to go through and assess your financial need for this money and kind of audit your assessment of that. And that was kind of a hard thing because if you were a nonprofit that had a large foundation, you theoretically could sit there and say, how could you sit there and say, well, we really need this money when you've got millions in this foundation, right? But I think the argument always was when the opportunity was there to apply for these PPP loans and any of these monies, it really was kind of like, I liken it to when, you went to college or your kids are going to college and you need to you're scrambling to get scholarships and grants. I mean, you're applying for everything. Let's try to get what we can because we don't know how this is going to impact us or how long it's going to impact us. So realistically, I think the argument could be made that everyone felt there was a need no matter how much of a reserve that you had. So it was kind of interesting that they were going to try to audit that. And I think, I know they've softened on that now. And in some regards, I don't think are even auditing that good faith certification anymore. And then, I touched on the provider coronavirus relief funds, provider more so if you were a healthcare nonprofit. And, these were dollars that were coming in and they were there to offset any lost revenues you might have and or to cover any COVID related expenses in the form of the equipment you needed, COVID tests, whatever the case may be. And these were being you would record it under that grant model 958, okay? And you would basically recognize the revenue when you had incurred the expenses or had the lost revenues to offset that. Okay, so in a lot of cases, we would see where the organization maybe picked up 100% of these dollars in revenue in 2020 and didn't defer any because they had all these qualifying expenses. In other cases, it might be split. They recognized some of it because they had them, but also in 2021, they had COVID outbreaks or other shutdowns in the first quarter because you remember in Ohio here, we had all those issues back after the holidays and everything. So they knew they were going to have qualifying expenses in the first quarter of 21. So they didn't recognize it all in 20 and deferred some of it to 2021. And that's all okay. The big question that was out there, and it had to really do more with the single audit piece, was that how is this going to impact single audit? And in the interest of time, and I have some slides later, I am going to just mention this now. Some nonprofits typically don't need a single audit, meaning they don't expend over $750,000 in federal funds, which would require a single audit, which is a compliance audit in addition to the regular financial statement audit. And the question became, well, how are these monies going to impact my single audit requirement? And what does that even mean, right? And so from that perspective, there was because of the uncertainty, a lot of 2020 audits for nonprofits were maybe getting delayed a little bit until there was clarity on that. And some of that may be opportunity too, to say, well, if I only expend, $450,000 this year in 2020 and the other $450,000 in 2021, maybe I'll get out of that single audit requirement. So because it impacted maybe how much revenue they were going to recognize of that in 2020, it delayed, some of these audits. The other side of it is you could do the financial statement audit, but then have to go back and do the separate single audit piece and issue a separate report later, which could also be done. But recently, over the last month or two, clarity came out there that realistically, the CFA, the Schedule of Expenditures of Federal Awards, which drives whether you have this single audit requirement or not, you would not recognize these provider relief funds on your CFA before June 29th, 2021. Meaning it's going to mirror, the timing is going to mirror when you report in the portal, and the reporting is going on now for the phase one funds. So in theory, none of these funds would end up in 2020 or need to end up in 2020 for single audit consideration. And so then it was kind of a collective sigh of relief knowing we can wrap up 2020, and now we'll have to deal with this more so in 2021 from a single audit perspective. So that was that. I know we only have 10 minutes, so I'm going to try to be select with some of the other things I touch on. There was the deferment of employer Social Security taxes, which I talked about there before. That's the opportunity for the employer to defer those. Those are just a liability on the books, but you'd have to break it out between current and long-term liabilities if you deferred any of these dollars, because half of it needs to be remitted back December 31st, 2021, and the other half then in 2022. So you'd have to split those between current and long-term. Then from a healthcare standpoint, you had the Medicare accelerated and advanced payments, and those were monies that Medicare gave to the providers in April of 2020. And then the repayment of those, though, it's actually more of a recoupment that occurs over 2021 and 2022. This is a little bit harder to estimate because it's actually based on Medicare volume in 2021 and 2022. So depending on, you'd have to almost estimate what your volume is going to be to figure out how much is going to be remitted back in 2021. And this is in the form of an offset of existing Medicare payments and how much would be in 2022. A lot of organizations just took an easy approach and said it would be 50-50 or somewhere in that ballpark, which is probably about as reasonable as you can get if you can assume your Medicare volume is going to remain the same. And then the employee retention credit, which I talked about a little bit earlier, and this is really, again, based on the name alone, you can see it encourages organizations to keep employees on its payroll. And it's a refundable tax credit against the employer's share of Social Security tax, okay? And then what organizations do is they record it. You should record it using the same guidance as you did for your SBA forgivable loan, depending on whether you used ASC 958 or the public company option, which most nonprofits probably didn't use based on the other options out there. But if you recorded your PPP under the gain contingency, then you could use either 958, which is the conditional grant, or IAS 20, which is the public company option. I would say for the most part, what we're seeing is that organizations are using 958, and that's saying that as soon as they know, or as soon as they have made the assessment themselves or from an outside third party that they qualified for this, and they're going to amend their 941s and get this money, it's being recorded then as a conditional grant on their 2020 books, assuming they went back and requested this credit for 2020. So that's kind of what we're seeing in our client base right now. And there's actually a sample footnote in here, which kind of gets into a little more detail on that. So my second word, and I guess I'll give you a third word then in 8 minutes. My second word is your, Y-O-U-R, okay? Your, Y-O-U-R. So then if anybody missed the first word, I'll throw you one here and give it again. So the first word was drink, and the second word is your, Y-O-U-R. So drink, your are the first two words. And then in 7 minutes, I will give you the third word. So single audit, I touched on a little bit before, and we talked about the PRF funds on the CFA, the Schedule of Expenditures of Federal Awards. I think the key here is when you were determining whether the single audit requirements would apply, meaning you expended more than $750,000 in federal funds, the PPP did not apply. You didn't have to factor that in. So that was a big thing. That was a big question at first. And the fact that PPP did not apply was a big one. And then most of the other funding that we see in the nonprofits that came through a lot of these different funds, most of it did apply, unless you, in certain circumstances, maybe you were just a pass-through entity. But most of the funding did apply, and it's kind of labeled out through here on the slide. So I'm going to move on because I think it's important to note that I mentioned, some nonprofits maybe didn't have the single audit requirement at all prior to this, and now they do all of a sudden, or they will next year, depending on when they're reporting some of their funds. I think the key with that is, and it kind of goes back to what Mike and Tony talked about on their fraud session, is that the internal controls, all the controls you have in place to prevent fraud, a lot of those controls are very important to have from the single audit perspective, because what happens is, in the single audit sense, all the monies that all the federal dollars that came in and got spent of the program, that's being audited under the single audit, the auditors have to come in, or we have to come in as the auditors and assess the internal control around those dollars, okay? And then test a large sample of transactions of both ins and outs of those dollars in your organization. And the internal control piece is a huge first part, because if there are any issues in your internal control, be it in the form of significant deficiencies or material weaknesses around those funds, then that becomes a finding in the single audit report, okay? And that's the one thing the first thing you want to avoid is a finding on internal controls. You want to make, the government doesn't want to give you money if you don't have good control of it. So it makes sense. So what you really need to do is take a look at, how these funds come in, how were they spent, what are our controls around it, and, make sure that you have everything buttoned up there, because you want to try to avoid that. Because then the next step is, then the compliance of those funds is, were those funds used on the right things, right? Why were you given these funds? How were they spent? Were they used on the right things? That's the compliance side of it. And if there's any issues there with the dollars were spent on inappropriate things, then that would be another finding in the report. So it's a little scary if you've never gone through it before. Organizations that have them all the time, they have good policies and procedures in place. But really, if you're a nonprofit that hasn't gone through this before and you're going to be facing this in 2021, we really want to make sure you talk to us, ask us questions. We can help you with some samples of receipts and disbursements of federal awards policy. So please reach out to me or others in the group, and we can make sure to kind of handhold you through that if you hadn't been through it before. Just have a couple other things. So actually, I think I'm going to be pretty good on time here. Debt covenants, this was a big question as all these monies were coming in, is how will my bank deal with these from a debt covenant perspective, right? And the main answer was it depended. There were large national banks that were, they were hard and fast, and they said, you know what, this is how it's going to be. We're not going to allow you to pick up the PPP in there. We're not going to allow you to pick up the stimulus. We have a national policy. This is how it is. At least that's how some of the large banks were initially. Or maybe you have a small community bank that you work with. Maybe you're a rural nonprofit, work with a small community bank. Oftentimes those were a little more lenient. They would work with you and say, well, we'll let you pick up the PPP in there, or you can have the stimulus funds in there, because realistically, those dollars were there to help keep you afloat. And really, the pandemic really shouldn't be a reason to trigger a covenant violation if it can be avoided. And, you were able to keep up with your payments, you have a good plan going forward. So, the long and short answer was it depends on how these funds were treated, by the various banks in the process. So lastly, because I feel it's important to touch on, is going concern. And going concern is whether there's substantial doubt about whether your organization will be able to still be around, still be in business, meet all your obligations as they become due within 1 year of the date the financial statements are issued. And that's a key distinction, because going concern used to be 12 months from the cutoff of your statements. So if you were at 12/31 year end, going concern only needed to be assessed until the next 12/31. So if your audit was getting wrapped up in the summertime, you realistically only had to look out 6 more months to make sure that there was no going concern there. Now, as auditors, we're required to have you as management provide us with why there is not substantial doubt, why is there not going concern issues, and then we audit it, okay? And I've kind of, the last bullet point here talks about how you as management should evaluate going concern, an analysis you should put together and everything, okay? And then provide that to your auditors, right? Now, but the issue became, because of COVID, was, what should your analysis look like, right? It was probably hard in 2020 to really look at and forecast future cash flows until you knew, what things were going to look like down the road. It was hard, nobody had a crystal ball at that point. I would think now, as we're in 2021 and we kind of see just how we're living with COVID-19 and how we're going to have to live with it, at least for the foreseeable future, there's a lot more, I wouldn't say stability, but there's a better ability to hopefully forecast some of those cash flows as you get into your year-end 2021 audits and are providing your auditors, us, with your going concern consideration. And I think just as a few reminders here of things you can use to support your probability of going concern is, how much cash do you have on hand? Do you have a foundation that's out there that can help fund you? What's your line of credit situation? are you able to defer cash payments if you had to? Is there a way that are your contributors or donors, are they starting to ramp up donations now that things are kind of returning more back to normal, or are there other related entities out there that could help you raise capital? And so those are all things that as you're assessing going concern for us as your auditors, we take that into consideration, and then that'll help that. So if there is going concern, we would have to just potentially disclose it in the footnotes or even in the audit report, which is not something you really want to have us do. So with that, I hit the finish line right at 10:50. My final word is Ovaltine, Ovaltine, Ovaltine. Because it was colder today, I felt like we're getting closer to Christmas, so I used a Christmas story theme with my 3 words for drink your Ovaltine. And the funny thing is, just real quickly, then we'll drop off, is that a couple of years ago, my grandmother was in an assisted living, and I used to shop for her before she passed away. And she sent me to the grocery store to get her Ovaltine. And I hadn't, other than the Christmas story, I probably never even seen Ovaltine. And so I go to the grocery store, and I don't know where to find it. So I have to ask someone, where's the Ovaltine? Well, of course, they don't really know. And I finally found it. And as I'm checking out, of course, the cashier's got to make a comment like, Ovaltine, I didn't know they even still made this stuff. And so, that's my lasting experience with Ovaltine, was buying that for my grandmother a couple of years ago. So with that, I appreciate your time, and hopefully you enjoy the rest of the sessions. I think there's a couple more sessions here. I assume everyone in the financial track will probably stay in that track for the next session, but appreciate all your time today. And please reach out to me via email with any questions you might have. Take care.